Hey guys, welcome back to the channel where it's the best place to learn about Canadian finance. Welcome back to 2021 and let's kick off the year with a Canadian real estate video. Now in this video I'm going to be talking about two parts. One is my top 5 lessons that I learned looking back in terms of real estate, and second part is instead of updating what happened previously in the real estate market, instead I'm going to look ahead and based on different resources and information what we might be expecting moving into 2021 for each major cities in Canada. Alright, without further ado, let's jump into today's topic. Alright, so let's first talk about what I personally learned, my top 5 lessons from 2020 in terms of real estate looking back. So the first lesson I learned is some things just can't be saved. Now in 2020 we went through a pandemic and the government tried their hardest to save the economy and also the real estate market. They do this by buying a lot of mortgage bonds, thus lowering the interest and also having the banks to defer payment for at least 6 months. In addition, they push out a lot of benefits to try to put more money into people's pocket. Now in most cities, this has done its job and kept the market high, but there are just some things you can't save. For example, Toronto downtown, which relies heavily on rental market, that part of the area you just can't save. So if someone wants to move out because of pandemic, because of work from home, they're going to do so regardless what kind of incentive you throw at them. And this taught me that if in the future I want to buy another investment property, I better not buy in core places that the house price is so expensive. Most people are renters in there, because if something happens to the market, suddenly overnight, people can all decide to leave. And now I'll be left with an empty yet very expensive condo that I can't get rid of. Now, second lesson I learned is that buying power trumps everything. This is something that we both got right and wrong as we were making different real estate videos throughout the year. We were right in saying that with the mortgage deferral and the low interest rate and the CRB, it's going to directly inflate people's buying power, and also it's going to inflate asset price in the long run, as we saw in December 2020. However, we also got some wrong. We're saying that a temporary drop is probably going to start at the top level where the house are, and then it's going to ripple through to the condo market. But in the end, what we saw was that the market separated into two parts, where it's the big units and the small units. The big units all went up in price because the buying power was inflated, and the buyers were people that were not really affected by economic downturn. So it didn't really matter to them. They got the benefit of the low interest rate, but they didn't take any negative impact of unemployment, etc. So that part of the market basically ignored economy. It's the smaller units, especially the rental properties, that have really taken a hit. So in the future, if we were to look at data and information, we would place anything that affects buying power as a priority above other factors. Now the third lesson is cash flow and liquidity is key. In 2020, we saw a lot of unemployment going on or reduced work hours. Even though there's a mortgage deferral for 6 months, I still have a lot of clients that were financially stressed out by the event. I've also had a lot of private message from subscribers who are investors who have stretched themselves to the max and held multiple rental properties. And because the liquidity is locked up in the real estate and also their cash flow was already negative to start with, any impact on the rent or renters moving out really put them in a very, very stressful position. Now for us personally, we had the opposite effect. We actually changed property at the end of 2019, and that helped us free up a lot of cash and liquidity. So it allowed us to move fast and make quick decisions on good real estate deals and take advantage of the market crash in March. And this is something I put extra emphasis with my clients when I went through numbers with them. You need to check your cash flow all the time and leave liquidity for yourself via HELOC, line of credit, emergency funds, or other liquid investments. As we saw in 2020, if you buy things with no wiggle room, you can be in for a very bad time. Now the fourth lesson is to act with clear reasons. So last year I've got hundreds of emails and private messages from subscribers asking whether they should invest in something now or wait or buy or sell a property they have. But when I inquire further about details or their goals and purpose, we realize a lot of them don't have clear reasoning to do something. They're basically just asking because they heard someone say something and they're really scared of missing out. So the big takeaway is it doesn't matter what kind of action you have in mind today. You need to ask yourself, what are the clear reasons to do something or not to do something. Now, the last lesson is actually to enjoy the process. Because at the end of the day, everything you're doing here is to build towards your finance and build towards a better future. And no matter how much you research and how much you plan, not everything is going to go exactly your way. But that's also a positive because you're going to learn a lot that you never thought of as you go through the process. Now, some people I'll talk to is so focused on having everything go perfectly, or they're crunching numbers to the last cent, and it kind of sucked all the fun out of the process and they became extremely stressed. So yeah, at the end you might get a little better return, but compared to the stress you created for yourself, was it really worth it? So no matter what you're going to do this year, make sure you plan, you research, but most importantly, make sure you don't lose sight of what you're trying to get here. You're building towards a better future. You should keep it positive, keep it fun, so you actually enjoy the process and you can learn something from it. Alright, so now we're done with the lesson. Let's move on and look at, for each major city, what we might expect for 2021. Now, to look ahead, there are basically 5 major forces that we need to consider when it comes to housing market. The first one is core demand. So these are the important things like population growth, what's the existing home price already, interest rate, and also funding options, for example, equities and savings that people did since last year. Now, the second driving force will be secondary factors. These are non-direct related things that could impact the market, things such as foreign capital or local investors and flippers. And third driving force will be government policies, things like their tax policies or mortgage policies, affordable housing, etc., that can also impact supply and demand. Second last driving force will be supply, active listing, rental vacancy, short-term and long-term, etc. Now, finally, the last driving force will be market sentiments. So what are people thinking about that specific city? For each city, I'm only going to talk about the first 4 driving forces. I'm not going to talk about the market sentiment, and that's because usually we don't know what the sentiment is until we get there. So to me, there's no point of trying to predict for now. Now, these are going to be a mix of different things I've been seeing online, but one website that especially did well to capture everything and make it digestible would be a website called Mortgage Sandbox, which I will link for each city's article below. So if you want to read in detail, you can do so. Alright, so let's first look at BC, and here we're going to look at Victoria and Vancouver. So starting with Victoria, first let's look at the core demands. We're going to look at population growth. Now, no doubt it's going to be lower in 2020, but this really doesn't really affect Victoria too much because usually it's the Vancouver people who have been living in there for quite some time that's coming in. There's much less new immigrant choosing to come into Victoria. So for home price in March of 2020, Victoria home price versus income, it's already at 58% of income. This is before pandemic. So at 40%, usually that's the benchmark, that's the affordable benchmark. Anything above that, it's unaffordable. But since we're already well past 40% before the pandemic, so people in Victoria are already used to this kind of situation. So what that means is, even if the home price is this high, it really doesn't change people's perspective when it comes to buying properties in Victoria. However, for home prices, especially for single house and townhomes, the valuation have gone up in 2020. This has freed up more equity for people available to either borrow against or sell their house to upsize. And with unemployment, Victoria has a pretty low unemployment compared to rest of Canada. So on the income part, not many people is affected. Now, for secondary factor, there are policy in place, but higher price and lower rent plus travel restriction is keeping most long-term and short-term buyer out anyway since last year. So unless there is going to be any changes in 2021, this likely is going to stay the same, and there is going to be reduced demand for smaller condos. And for the government policies, we used to have different policies like CWS, CRB, mortgage deferral, and tenant evictions in 2020. Now, all of these programs are gone except for the CRB. But as we saw from the unemployment chart, it is on the lower end for Victoria. So what that means is less people are likely to need these benefits. So likely if these programs do phase out, the only people I see can really get affected are probably smaller condo owners. In addition, the government also have an increased tax on foreign owners, and also on October 2020, everyone have to go through the BC Corporate Ownership Registry. So it's much harder to buy condos with corporation and shell company right now. But this is likely going to affect Vancouver a lot more than Victoria, because many people that are coming into Victoria is intended to live in there and work from home. Now, lastly, on the supply, pre-sale completion in 2020 is keeping up with last 2 years. So we have a steady supply. But since pre-sale does need a 70% sale to start, we're seeing that in 2020, not as many people are buying pre-sale, as we see a much lower start than the previous years. So in terms of pre-sale market, it's very sluggish. So in the future, there can be a gap in the supply due to lower completion because of lower starting right now. So overall, I think it's going to be sluggish and even flat price for studio, 1 bedroom, and also 2 bedroom going into 2021. However, for bigger units like 3 bedroom, townhouse, and houses, we're probably going to see some increase still, but it's going to be much less than last year. Because if Vancouver and Victoria price start to get closer, there might be more buyers that change their sentiment towards Victoria and head back towards Vancouver because the price are very similar anyway. And if that happens, we might see a sudden drop in demand and price in Victoria. So that's something we need to keep in mind of. Now next, let's talk about my hometown, Vancouver. So for core demand, population growth wise, like we said, there's lower population growth and likely it's going to extend to 2021 due to restrictions. For Vancouver, we're going to feel this much more than Victoria because that's where most new immigrants will settle, which is inside Vancouver. Now for Vancouver, we're the most expensive in Canada. We're already at the 80% household income versus average home price. That's an insane amount. And what that means is if you can afford a home right now, you're going to stay in the pool. For the people who cannot, it's going to be very difficult to stay out. However, one thing to keep in mind is from talking to a lot of people and doing some surveys in my group, there are a lot of people who have saved up a huge chunk of down payment in 2020 due to lack of traveling and eating out. Plus, even though TSX is down, if we look back for 1 year, S&P 500 and NASDAQ are way up. So if you have stayed invested in the US market or even made changes during the market crash, you're likely going to grow your down payment a lot more last year. This could actually bring more people over the barrier and let them to have enough down payment for their first home. Now, when it comes to unemployment, Vancouver unemployment is lower than average, but it's still quite high. One thing to keep in mind is people need a 3 months employment at full time before they can try for a mortgage, or if you're self-employed or a small business owner, you will need a 2-year average. What that means is with this unemployment rate, it can curb some first-time home buyers from entering the market if they have suffered unemployment. They need to wait a bit. And if they're self-employed or business owners, this could drag their ability to buy a property well into the 2020 because they need that 2-year average. And one more thing to consider is Vancouver home insurance is increasing significantly. We have already increased a lot last year. I'm foreseeing more increase this year. This is really going to put pressure on strata, and this actually have a huge impact on mortgage borrow amount calculation because every $500 of extra outflow expense likely is going to reduce about $100K of borrowing power. So if your strata fee went up $100 or $200, it doesn't seem like a lot on surface, but it can make a difference on whether you can get that mortgage amount you're looking for or not. Now, moving on to secondary factor for foreign capital, we have foreign buyer tax at 20% and we had speculation and vacancy tax at 2%. Effective 2021, City of Vancouver is going to increase this to 3%. This may not look like much, but it can bring more impact to foreign buyers because a lot of them likely is going to assume this 3% apply to the whole Vancouver, and they may not know the difference between City of Vancouver versus Vancouver itself because of how similar the names are, and this might force them to seek other cities with a lower vacancy or speculation tax. And also, like I said, for Victoria, BC have implemented the BC Ownership Registry, which targets people trying to buy properties using shell companies or straw buyers. This can further deter foreign buyers who are really looking to buy properties in Vancouver. So overall, we're seeing much less upward pressure due to more restrictions on foreign capital flow. Now, in terms of supply, in 2020, we're looking at half of the amount for single house supply versus 2019, whereas condo is much higher. There's around 5,000 Airbnb listing as of March 2020, with 70% of them as entire home, so likely they're condo units. Now, looking at vaccine rollout speed, I do understand it's going to increase and improve in the long run, but travel is likely going to be restricted until June or July, so they're all going to want to convert them into long-term rental or just sell them altogether. Either way, it's going to add a lot of supply to the rental or sales market. Now, also, there is mortgage deferral. For Vancouver, we're at 11%, which is on par with the national average. However, one thing I know for sure is not everyone defer because they have financial hardship. Many people just defer because they want more cash on their hand. At this moment, this is an unknown because we have no data on how many people is actually going to face default since the mortgage deferral program have stopped. Finally, let's look at pre-sale. So as we said in previous video, this is going to create a problem. Condos that are completing in 2021 is actually bought 3 to 4 years ago, so they're bought at peak price. What that means is with these completion, it's going to be extremely hard to flip them and earn a profit, and also it's going to be very difficult to finance because the actual value is much lower. Many banks may not be willing to lend at the actual purchase price. It may have to reevaluate at a lower price, and this can pressure the buyers to put in extra down payment to fund the shortfall or pressure them to just sell it fast. So I'm guessing likely we're going to see a lot more urgent sale of reassignment happening, and this is going to add to the supply. So with all that 2021, likely we might see a little bit more increase in single house townhomes and big units, but definitely not as big as 2020. Now for 2-bedroom or smaller, we're probably going to drop in price just because how many units are completing and adding to the market. Okay, so moving on, let's talk about Ontario, and here we'll talk about Toronto and Ottawa. So for Toronto, let's look at the core demand. Population growth-wise, percentage, Ontario is probably the worst out of all provinces. Now for home price in Toronto, like Vancouver, we're at 68% of household income on average, which is way past the 40% benchmark already. And since we're here a long time already, it's unlikely going to do any change to the market sentiment. However, unemployment is much higher than national average. And like we said before, people need 3 months full-time income to get a mortgage approval, and small business / self-employed will need a 2-year average. So with this much unemployment, we can see a lot of people actually get affected when it comes to their mortgage approval. Some will delay by 3 months as long as they can get a job, but some might delay 1 or 2 years, and this might last until 2023 because they need that 2-year average. For secondary factor, in terms of foreign capital, we have a 15% foreign buyer tax. There is also restriction on traveling, so very little outside people can come in to buy. 40% of Toronto's condo are not owner-occupied, so this is a market that's super reliant on rental. And as we've seen before already on the map, rental took a huge hit in 2020. This place is definitely falling out of favor with investors after this pandemic. I imagine many people, even if things back to normal, they're going to think twice before they start investing in Toronto. There's probably much better places in Canada like Ottawa or Montreal if you want to get into the rental market. For government policy, we do have a first-time home buyer incentive. This is a new thing that government will lend you some money to buy, but at the sale of property, you have to pay it back. It sounds nice, but in reality, only less than 1% of the purchase in Toronto have used this program. It's pretty much useless because the cap is at market value of $505,000. So anything more expensive than that, you can't get into this program. Now in 2021, we're seeing that the program is going to expand for Victoria, Vancouver, and Toronto to $720,000. But unlikely this is going to help much with the housing market because the program seems to be very unpopular. Now for property tax, it's interesting to see that Toronto Council in December have voted to increase 8% for property tax over 6 years. Now, if you divide it by 6, this is very little impact at this moment, but the city have commented that it needs to increase property tax by 47% in order to make up the $1.5 billion of shortfall. Now, even though for now the 8% increase over 6 years doesn't really impact the market, it could be a significant factor if the city keep increasing, because one, people will start paying attention to the cost, and second, it's going to affect mortgage approval amount. So lastly, let's look at supply. As we see, housing market like Vancouver have halved for single house compared to last year, but condo have tripled. In Toronto, we have over 23,000 Airbnb units, with 64% of them being entire homes, so likely they're condos. This is going to add a huge amount to the market if it hasn't already, because we'll unlikely go back into business until July. So all these people are going to look to convert to long-term rental if they haven't already, or just try to sell it outright. And also, mortgage deferral is slightly higher at 12%, but again, it's not enough data to really see how many people will get affected. However, if we look at pre-sale, we can see that for 2020, the number of projects starting have kept up with last year, so we know they have sold pretty well in the early 2020. Now, we're seeing a record level of under construction, which is due to complete in 2021 or 2022. And similar to Vancouver, they're bought at peak market price. So it's going to be very hard to finance, and it's definitely going to add a lot more supply to the market. This is likely going to bring condo price further down, especially smaller units. And you're likely going to see a lot of reassignment and some pretty desperate sales. So you might be able to find some good deals. But like I said before, do your research and run your numbers thoroughly before you make a decision. Now, for bigger units, especially single house like Vancouver, we'll probably see a steady increase, but not as much as last year. All right, next is Ottawa, which we think has a complete different story than Toronto. First of all, core demand population growth we know is lower, but affordability is only at 39%. So even though it's at max in terms of affordability, which is a 40%, but as we see in Vancouver and Toronto, people are still buying when the affordability is well above 70%. So even though it's at 39%, looking at more popular cities, it probably still has some room to grow. Now, in terms of unemployment, Ottawa is lower on the chart, and also their average income is higher than average. This is due to more government jobs and headquarters being in Ottawa. Now, unemployment is still going to impact some people's available mortgage borrowing amount, but we're likely going to see less impact versus Vancouver or Toronto. In terms of home cost, there has been a 3% increase in property tax for 2020, and another 3% will propose in 2021. This is going to factor in the mortgage borrowing amount. Now, lastly, for rental, even though smaller condos have dropped, it's still very little change. However, big units have increased in price, and because the change is not big enough either way, it's not going to sway investors when it comes to their perspective of Ottawa. Now, for government policy, it's very similar to Toronto, so I'm not going to repeat here. And for supplies, for mortgage deferral, we can see it's very low. This is corresponding to what I said before. Job security is high in Ottawa, so many people actually don't need to defer their mortgage. For pre-sale, we're actually seeing 50% more starting than last year. Since they have to sell about 70% to start, we know Ottawa pre-sale have sold extremely well last year. There's also a record level of under construction and completion. Now, this may lead to oversupply in the future just because how much supply is coming in. But as we see from the pre-sale sales activity, demand is still very high when it comes to Ottawa. And that makes sense because it's still deemed as very affordable if you compare this to Vancouver and Toronto. So some people online might say that Ottawa home price may drop in 2021, but personally, from all these numbers we're seeing, we think it's still going to increase for all properties going into 2021. Okay, so next let's look at Alberta, and here we'll talk about Edmonton and Calgary. I'm going to talk about them together because they're very similar. So first, for core demand population growth wise, it is lower but not as bad as other cities because from last year's, it probably have lower growth anyway. Home price there has been a huge drop in price for the last couple of years, making it more affordable, which actually can bring more demand to Edmonton and Calgary. Unemployment wise, 35% of Albertans still experience COVID-related disruption to employment as of September 2020, and this makes sense because oil price is still extremely low and a rebound is very unlikely, especially if there's no travel until July. So employment is going to stay low as long as oil price don't rebound. This is why if we look at these two cities, they're top of the chart when it comes to unemployment. Now for secondary, like we said, low oil price, which lead to low foreign capital flowing in. For this province, you probably don't even need government restrictions because foreign money just don't want to come in anyway. And for rental, it has stayed around the same level. Government policy, there's really none going on at this moment, with the exception that ending of a lot of the benefit programs may add a lot of financial stress to people in Alberta compared to other provinces, as we will see why in the supply side. So when it comes to supply, the existing inventory is adding up even though sales have been going all right. There is going to be a lot of room for bargain in condo market. So if you're looking for a condo in Alberta, now is probably a very good time. Now, mortgage deferral, it's very, very high. Okay. And we said before, like other city, we're not sure how much people are actually affected when it comes to mortgage deferral. But for Alberta, it's very likely most of these deferral are happening because people actually need these deferral. So with the program ending, in the next 6 months, we're probably going to see a lot of defaults happening in Alberta. Now, there are many people who went through private lenders. These are likely going to get their loans recalled when their terms are up because private lenders are probably feeling not very confident to keep lending their money out given the pandemic and the low economic activity in Alberta. So as of August 2020, 21% of Edmonton mortgage holders and 18% of mortgage holders in Calgary were still unable to make payments. And this is why I'm saying for the benefit program, if it ends, it's probably going to put a lot of stress on people in this province. Now, no doubt pre-sale start is very low because with how much price have dropped, people can just buy something that's already built. They don't need to wait. But completion and under construction is on par with last year's. So we're probably still going to see a lot of inventory coming up. The low start is not going to show its effect until probably 2 years later. So overall, we're going to see house price probably remain the same level, but the sales speed is probably going to slow down considerably. Now, condo is unlikely to increase and may even drop further as completions are coming in. Now, finally, let's talk about Quebec, which will focus on Montreal. For core demand, there's very low population growth, but we don't really see this affect the short-term demand because internal demand seems to have not satisfied yet. As of March 2020, Montreal's ownership cost is at 43% of household income. So we're a little bit over the affordability threshold of 40%, but compared to other popular cities like Vancouver, Toronto, which is well over 70%. So we still have some room to grow, and as I will talk about later why this is especially true for Montreal. Unemployment is on par with average, and it's interesting to see that Quebec City is actually quite a bit lower. Now, ownership cost is not much increase. Property tax is up 2% last year, but 2021 there has been a proposed freeze. However, the city is 500 million deficit, so in the future, some costs will likely go to homeowners. However, all these should do little to deter buyers for 2021. Now, for secondary, unlike other cities, there's no foreign buyer tax. So this is why many foreign buyers are flooding to this market. And this is why I said at 43% household income, we still have a lot of room to grow because of foreign buyers coming in. Long-term rent is lower for Montreal, but this really doesn't have much effect. Now, for government policy, this is interesting. Quebec City has implemented rule to identify foreign resident beneficial owners as of October 2020. This is likely going to be a setup to implement the foreign buyer tax. Now, this is important because if it passes, as we saw in Vancouver and Toronto, this can really put a dent in the market. But so far, we don't know if this policy will come or not, so that's an unknown for now. Now, lastly, supply-wise, we're looking at low supply in all market. But Montreal does have 20k Airbnb units and 70% of them is entire homes, so likely they're condos. With restriction extending likely to July, we're probably going to see a lot of them converting to long-term rental or trying to sell, and likely it can bring a condo market back to a balanced market. Now, for mortgage deferral, Montreal is at a lower end. And for pre-sale, it's very high across the board, no matter you're looking at starting, under construction, or completion. And this is because many people are still coming into Montreal, as it is one of the last places without a foreign buyer tax. And also, if they're looking for a vibrant city, this is probably the second most vibrant after Vancouver, with way more affordable properties. So if someone wants a smaller, busy, condensed city, and they don't want to afford Vancouver, they're probably gonna choose Montreal. So for Montreal, this is more interesting. It really depends on the foreign buyer tax. If there's no tax implemented, then 2021, we're probably gonna see the whole market go up regardless what kind of property you're looking at. But if there is a tax implemented or announcement of the tax, then you could see single house or small condos take the biggest hit, because those are the two favorites of foreign investors, and see a drop in price. Alright, so that's everything I want to share for first video of 2021. Let me know what you think in the comments down below. And if you haven't already, subscribe to our channel and join our private group. Alright, this is Jacky. I hope you found this interesting. Happy New Year, and I'll see you next week. Bye!